Well, hello, everyone. Welcome to Maverick Trading's 2022 year in review. This is Darren Fisher. I'm joined by Rob Reinhold and Corey Halliday. And let's take a look at exactly what happened. So we're going to go over the State of the Union here. And this is what happened last year at Maverick Trading. Now we made, and this point isn't up here because I think this goes without saying, but I do want to pat every one of our traders on the back. There were 3 really good tradable down moves in both the S&P and the NASDAQ. And you know what? Our traders were on the right side of every one of those moves. When the moves started to reverse, they got out, and it was a good year for a lot of people. And so, I want everyone to take the time to pat themselves on the back. Not many people have seen bear markets, and the fact that not only did we as a firm weather it well, but actually our traders made some really good trades and some really good profits last year. So I want to give a kudos to our traders for being on the right side of the trade. We had very few people that were beating their head against their desks saying, no, I'm going to go long. This year is going to pull itself back up. We looked at the trend, and they just followed it. So I really do appreciate every one of our traders doing that. So what else did we do? We made a shift in the curriculum, and we wanted to focus on trader psychology. The reason we did that, it was something that we've been doing for years, but it was almost kind of catch as catch can. It was a nice to have. And we made that shift into the curriculum so that our traders are more consciously and consistently focusing on their trader psychology. And the reason we did that is because you can learn the basics, the ins and outs, the techniques and tactics of trading in about 6 months. But if you don't have a good trading plan and you don't understand trader psychology, you're constantly going to be fighting against yourself. So we've had really good feedback from that. In conjunction with that, we also launched our Trader Personality Test website. And the reason we did that, this is a standalone site that our traders can go to, and they answer some questions, and they get what their personality is. And the way we did it before, it was all self-scored. This is all automatic. It goes much smoother for our traders. If you've not seen it, I highly recommend taking a look at it. It's traderpersonalitytests.com. And you'll be able to go in and see the strengths and weaknesses of your personality itself. And you'll be able to see how you statistically, someone with that personality reacts to a certain situation.
Let me jump in here and just say that this was like 3 years in the making. And there is no other website out there that breaks down a Myers-Briggs-like personality score specifically for trading. And so we've been developing this for a long time, and it finally got all buttoned up this year. And we're really excited for it because now our traders just go in-house, they go take the test, they get their results delivered, and it's specifically about trading.
Yeah, I mean, that's key right there. I mean, we're not going to talk about your individual love lives here in these things. This is devoted directly to trading. And once you take the test, you're going to get yours as well. But then you can also go and explore other types of personalities. So if you know a friend of yours has a certain personality type and they're going through a hard time in trading, you can click on that personality type and say, I bet you're having these problems. And they're going to look at you with reverence, like you have a halo over your head, and say, how on earth did you find that out? And you can point them to the trading side as well, the trader personality test site as well. So we're finding this, again, to be a very good tool. A lot of good feedback on it as well. And actually, I mean, this wasn't conscious. We did this for our traders, but we're getting a lot of people outside the firm are also coming to look at what their personality test is as well, personality type is as well. So we're actually kind of happy about that too. And the third major push that we have, we really started leveraging YouTube for a lot of the non-curriculum videos that we have. And we're not only doing the non-curriculum stuff to make it easy to view, so you don't have to log into the website and get the non-curriculum stuff. We're doing topics that don't have a good place in the curriculum. Talking about the different, leveraged and inverse ETFs. I mean, we have a very in-depth hour-long class on that. But if you just want a 10 and 15-minute class on something like that, we've got a series of these classes out there that don't fit into the curriculum, but they're kind of like some additional seasoning and spice that a good trader would want to know. But maybe you only have 10 or 15 minutes while you're commuting on the train or something like that. You're on your lunch break, whatever. you want to see that, go to our YouTube channel. We've got one channel for Maverick Trading, one channel for Maverick Currencies as well, and you'll be able to see all the content that we've put on there. And so we're really happy with the way that's building out as well.
Hey everybody, this is Rob, and nice to be here, and great job everyone. I want to echo Darren's thoughts. Great job. We're going to wrap up 2022, and one of my favorite things about doing this year in review is that we close up the books, we button up 2022, and then we never look back, because the market doesn't care what we did last year. It doesn't care. That's totally forgotten. So we're just going to go through the last little bit of 2022, but I want to really focus on 2023. One of our favorite things to do in these sessions is to make these predictions. And not just trading predictions, because we do that literally every single day, every single week with our end of day reviews and our trading rooms. But this is more like a big picture. What's likely going to happen? Now, these are taken directly from last year's. We called that the equity markets were going to be lower. We said the S&P was going to be down around 10%, and the NASDAQ was going to be down around 20%. And we also said that this was the year that the bubble was going to pop. Well, we were actually not bearish enough. We were not bearish enough because we saw the S&P drop 19% and the NASDAQ drop 33%. So I'm going to give us a good solid B+ on this one, because the markets did have a really nasty year. Second call we made was that interest rates were going to rise sharply. Just like our prediction with equities, they rose way more than we expected. We thought 2.25%. It was double that. So we said it was going to double, and they tripled. So, okay, let's give us a good solid B on that. Corey, I know that you do a lot with rates. Did you get surprised at all with how aggressive the Fed was?
Yeah, I mean, the Fed, well, not only that, but their guidance was just way different than what they actually did, right? So we came into 2022, I mean, it's a long time ago. Think about how different the world was in 2021. We had interest rates. The Fed funds rate was still down at 25 basis points, like 0.25%. We had mortgage rates down in the basement. We had all these things happening, and the Fed said they didn't expect to raise rates at all in 2022. And why was that? Because inflation was transitory. It was just going to, yeah, we were seeing spikes in inflation, but it was like it was a mirage. It was just going to kind of flash, but then it was going to go away on its own, and there was going to be no problem. And the Fed's guidance was that they were not going to hike rates at all in 2022. So at one point in time, they were expecting to just keep rates down at 0.25% for the entirety of the year. And we thought we were kind of smart and said, well, we're going to call their bluff on that. Inflation's not so transitory. They're going to have to hike rates a couple of times. We expect them to hike rates. We, again, weren't hawkish enough in terms of the way the world shifted. Not only did they hike rates, they hiked at an absolute historic pace. They hiked 7 times. They hiked from 25 basis points to 4.5%. That has never happened before. So I think our prediction was pretty darn good. We were calling the Fed's bluff, and yet it was not nearly enough. And that's kind of the story of the year, is even though we were bearish, even though we thought rates would rise, even though we thought the Fed was foolish, it changed way more dramatically. And that's the thing about the markets that you have to understand, is you always have to respect the amount of the ability of something to go to obscene numbers. Like if we had come in last year and said, it's at 25 basis points, but they're going to hike 7 times and the rates are going to go to 4.5%. I mean, we would sound like we were out of our minds. And most of the time you're not going to get that right, because that is truly one of those statistical anomalies. It's not going to happen. In fact, we've never seen it before, right? But that's what can happen statistically. You have your norm, and then you have your tail risk, as they call it. And that was certainly a tail risk, and the Fed found itself right there in the bullseye of that, and really screwed up. I mean, at the end of the day, the Fed screwed up royally, and now they're trying to fix that mess. So I was definitely surprised, and we weren't hawkish enough, apparently.
Darren was way more hawkish than I was, And you nailed it, Darren, but even it probably went past what you thought.
No, because I maybe it did. I don't want any of us to break our arms, patting ourselves on the back. But I always said that they had to get rates up to match inflation. And maybe we didn't call the number exact, but this sure put us on the right side of everything so that we could get more aggressive to the downside. So I would actually be a little more gracious in the grading on this. Just the fact that we totally ignored what the Fed said, and we said, no, there's no way. This is unsustainable. Inflation is going to come and bite them, and they can't ignore it. And to put that flag out there on that hill in January of 2022, I'm really happy that we made that call because it let us adjust more to the downside.
All right. Well, I just raised our grade because Darren came in and said we could raise the grade. All right. Let's move on to the currency world real quick. The dollar was really strong last year, and that had major implications around the world. We called that the yen was going to be the weakest currency, and we nailed that one. That one was an absolute bullseye because the yen was the weakest it has literally ever been in an entire year. We thought the Aussie and Kiwi would outperform. They were middle of the pack, but the yen call was a great one. We said that cryptos were going to get crushed. They did. We called again, the bubble is over. It was going to pop. It did. And we said for commodities, they were going to be flat overall. They weren't going to be down or up. Look, the one thing we did not predict was Russia invading Ukraine in 2022. So we get an F for that one, but I didn't hear anyone making that prediction.
That was on no one's bingo card. That was on absolutely nobody's bingo card in last January.
Agree.
Yeah.
So we got that big spike in oil, but it pretty much came down. We closed the year about where we started with oil. And so everything kind of mellowed out by the end of the year. So let's take a look at the actual numbers here. So Dow down 9%. Now look, the Dow, I wish we could just kill the Dow Jones Industrial Average. It is kind of the dumbest index ever. It's a price-weighted index. It's only 30 stocks. It doesn't make any sense. So let's just take a look at the S&P, the NASDAQ, the Russell. You can see the numbers. S&P down 19.4%, NASDAQ 32.9%, Russell 21%. International stocks really were actually fairly decent compared to how well they usually do when the markets go down. Like if the U.S. market goes down, you usually see at least 1.5 times of a drop. In internationals, they held up. The best and worst sectors, coal. That was on no one's bingo card either. Darren, did you see that one coming?
No, I mean, to take a look, I mean, energy put itself at the front of the pack early on, but I don't think we saw that coming at the beginning of the year. Once we did, though, I mean, we rode that horse for months. Same with communication services. Communication services had looked to be decent in 2021, and the mix that you see here is just really odd. I mean, to me, I mean, the financials. You take a look at those. Down 13. It's the oddest thing. I mean, the things that you would think would do well. I mean, we're in a down market, so nothing did great except for energy. Everything else, I mean, you could, you just have been short telecom, consumer, and tech, and long energy. I mean, that was going to be the trade for the year right there.
Yeah, the energy sector was the only thing up for the whole year. And so there wasn't a lot of places to go high. This was a really broad-based sell-off. Here is the yearly chart of the S&P. And Darren, you mentioned earlier 3 really big moves. So we had January to March, we had April to June, and then we had August to October. Now look, these are the big moves down, but I don't want to ignore the massive bear rallies. We had massive bear rallies off the bottom here. This is exactly what a bear market does. For any of you that this is your first time in a bear market, I've now had the pleasure to go through 3 of them. I love bear markets. The rallies in bear markets are huge. I mean, these rallies were 20 to 30% in just a couple of weeks, like 6 weeks, and then they rolled over and went to new lows. So as you can see here, really nasty candles, and there's really no relief by the end of the year. You can see that we are still in a long-term downtrend, and the economy is getting worse. So we don't really see any big change at the first of the year. If you take a look at the NASDAQ, same thing. We had big down moves with bear rallies, big down moves, bear rallies. This last bear rally was really pathetic. And you can see we are knocking on the door, trying to break to new lows here right at the first of the year. The markets are not coming into this year looking very healthy, except for this one, emerging markets. Emerging markets is all of a sudden showing us a lot of different things. We had this trend line that none of the other markets have broken. We've now broken above it. I am by no means getting bullish anything here, but when you take a look at what's happening early in the year, emerging markets actually look like they are performing the best. Now, emerging markets are simply the smaller companies or countries. Let's take a look at the world equity returns and just to see where the strength and weakness was. We know about all the problems in Europe, but if you take a look at European stock markets, they actually didn't do too bad. Take a look at the UK. If you would have told me the UK would only be down 4%, I'd tell you you're crazy. The US down 20%. So take a look around, and the one that just stands out to me is that Russia. Now look, it says negative 100%. It didn't go down 100%, but for all intents and purposes, Russian equities are closed off to pretty much anyone in the developed world. So Russia has just been its whole different story here. But some of the bright spots is Japan. Japan is a nice little bright spot there, and they were definitely helped by their weak currency. But if you take a look here, there was better performance around the world than we saw in the U.S.
Hey, Rob, and just one comment on that. With Russia, there is the possibility, like we don't know where Russian equities are, but if you own Russian equities or companies, there's certainly the possibility that they have been essentially confiscated by the Russian government, right? So they may never trade freely again. All of those corporations may now be the ownership. We've seen other countries try to do that. It collapses their currency and it causes all sorts of problems, but that may be the case. So Russia may be a zero, and you don't see that every day where it's the possibility that all of those equities are wiped out. We just don't know where that's at, and they haven't reopened for trading. There is no value there in Russia, so pretty weird circumstance in 2022.
Definitely a once-in-a-lifetime thing for me. I've been doing this for over 25 years, and that has never happened before. Lots of things really over the last 2 to 3 years are things that you never thought could possibly happen. So probably expect more of the same. It seems like that's the new world we live in. Let's take a look forward to 2023. We think the markets are going to continue to struggle. With that being said, we probably don't have as nasty of a year this year. We're looking for the S&P to be down 0 to 10%, maybe flat for the year. And we're looking for the NASDAQ to be down, negative 0 to negative 20%. We still think that there's a lot of air or of the bubble left in tech. Now look, it's been decimated. However, you need to understand that after the dot-com bubble in 2000, the NASDAQ went down 80% from its high. I'm not saying we're going to get there, but all I'm saying is there's a lot of air that needs to be let out during bubbles. And that's where we had the bubble here, was in the NASDAQ and the cryptocurrency. So I think there's going to be a lot of pain in those areas. Still, even though they got killed this year, they're going to get killed the next year. We think that the defensive value sectors probably rise. People are looking for safety. They're not looking for growth. They're looking for safety. I really want everyone to go back and study 2002, because the year we just went through was very similar to 2001. A bubble had popped. Everything came down in price. Go look at 2002. And I really think that that's going to be a year that we probably see this next year. We made 2 tests of some lows. It was not a great year. I think equities were down a little bit or flat, and the NASDAQ continued to drop. And what happened was just what Darren said. Any of these speculative companies, they were really, really punished, and most of them went out of business. I think that's what we're looking at this year. But in 2002, the average company did pretty good. They did okay. They didn't knock anything out of the park, but they actually did pretty good. Things like the Walmarts and the Costcos and McDonald's and just your normal companies, they actually had an okay year. Nothing great. Now let's move on to rates. We always like to make calls on rates because rates really drive this macro story. And last year was really an example of how much rates can move everything. Last year, the Fed came into the year saying they weren't going to raise, and they took a ton of action, way more action than the markets thought. So this year, I think they're going to start very hawkish. I think you're going to start to see inflation cool. Now, let me make a distinction here. You're going to see headline inflation cool. Now, what do I mean by that? Well, they have a number called the core inflation. Every month they release the CPI report. They give the CPI report, and then they give the core CPI report. The CPI report has food and energy and other volatile things. Once they strip those out, they go to the core. We are already at 0% headline inflation over the last month at the first of the year, but core is still at plus 3%. It's because wages, rent, things like that are very, very stubborn. So I think that we're going to start to see this headline number cool down, but the problem is the FOMC is going to look at that and say, no, we cannot cut rates. We can't cut rates, and I think they're going to talk tough. That being said, I think they're very, very cautious here to raise rates aggressively higher because they know they are at the tipping point. What do you think the Fed does this year, Corey?
Yeah, they're in a tough spot. I mean, unfortunately, where the Fed is at, they have to, the big risk is inflation, and that's what they've already gotten wrong. So they can't afford to be wrong about that any further, right? And so they're willing to sacrifice equities. They're willing to sacrifice the economy. They're willing to sacrifice the job situation to get inflation under control, in part because that's what they screwed up. And so it seems to be the bigger risk for them and so on. And it's sort of ridiculous. I mean, you think about the Fed and where they're at and the fact that they're essentially trying to increase unemployment. They're trying to create a situation where things calm down because inflation is too much chasing too few, right? It's too much money out there. And where did all that money come from? Well, how about the trillions of dollars that were printed and the fact that the Fed came into 2022 and was still in a bond buying program and doing these things to drive down interest rates. Stanley Druckenmiller has talked about this, that it was such a horrible risk to reward for the Fed. What were they thinking? Keeping rates down at those levels and stimulating when you're already there had little to no reward, but it had all the risk of inflation. And so what kind of trader wants to put on a trade where they have next to nothing in terms of profit potential, but this huge risk exposure? That's horrible. And that's essentially what the Fed did. So they have to battle inflation. The good news is, if you look at the inflation numbers, the way they're trending, they are trending lower. So we're on a pace. If you take the last couple of CPIs and you kind of extrapolate that over an annualized number, you say, okay, inflation gets back to a more reasonable number. Now, that's the past couple of months, and it doesn't have to stay that way over the next few months. But, you know, that's kind of where we're trending. So as long as that trend continues that way, the Fed is going to stay hawkish, and they're going to raise rates a few more times here, but then they can kind of stop and they can pause and they can look around and they can make sure inflation keeps coming down. If for some reason inflation spikes back up, then they've got a big old problem on their hands because they're going to have to keep rates higher for longer. The markets right now, interestingly enough, are pricing in rate cuts towards the end of this year, of 2023. So the Fed is saying, no, we're not going to cut rates. We got to get inflation under control. The markets right now are saying, no, you're going to back off. You're going to do something. And I don't know if that's because the markets really believe that, or if they've just become so ingrained to believe that the Fed always is dovish and so on. But I think our prediction makes sense to me, that they're going to hike rates a few times, then hopefully inflation kind of headline numbers come down a bit, and they can pause there. I know Darren has a little bit stronger opinion about inflation staying high and staying elevated, and that they may have to raise even further. And so that's kind of the worst case scenario, I would say, for equities. And if that plays out, you probably go S&P down 20% instead of down 10 for the year, and those sort of numbers come into fruition. So it could get a little more ugly in that scenario.
So it sounds like we're unified that interest rates are likely to not go down by the end of the year, and I totally agree with that. And so the Fed, many Fed members have already come out at the first of this year and say we're going over 5%. Here's the problem. The market is only at 4.8, 4.9%. So the market is basically saying, we don't believe you. And I think the Fed is going to say, no, you better believe us. I think we are going to be moving higher than the market thinks. Right now, we're at, the 10-year, right below 4%. I think we move up into the 4%, maybe even the 5%. And I think another reason why interest rates have to go higher is just what Darren said. Companies that need capital are going to have higher interest rates for anyone to give them capital. And that increases the yield on all of assets as people are willing to pay more for interest. I think it just moves everything higher. I do agree with you, Corey. I think the Fed does at some point have to back off this year. We will get them to back off, but it's going to be we're going to back off, but I don't see any way that the Fed lowers interest rates this year, even though inflation probably has peaked. The problem is when something peaks, it doesn't mean it comes down. It can peak and plateau. And I think that's what we're likely to see.
Yeah, I think I'm probably the one that most sees inflation as the problem. If you can go back to that slide there, I mean, you can see I'm the one who says that 10-year is going to get to 6%. At some point this year, that 10-year is going to get to 6%. And I think what people aren't realizing here is those mortgage rates. I mean, where the 30-year mortgage rate is right now. I mean, the 30-year mortgage rate's at it's about 7.25 right now, and that's with 20% down. So I think any type of moves by the Fed, 7.5, and those mortgage rates get up to 10%. That is going to literally decimate the housing market. I think we're going to see actual lowering in real estate values because people can't afford the mortgage to do it, to get into something like that. Especially in the mid-size to upper scale homes. Well, I'll take that back. I'm going to say that for anything. First-time home buyers. You give a first-time home buyer a 9% rate, and which I can completely see happening with a couple of rate hikes by the Fed. And you're talking, I mean, the last time you saw something like that was the mid-'80s. There's an entire generation of people that have never seen this. And I'm kind of with you. I think the Fed does get pressure from the markets to get more dovish, but then they see one or two leading indicators that CPI is going up, and they're going to have to put their foot on the gas again. I'm with you. I mean, I think the CPI does moderate a little bit. I mean, we're probably not going to be up at the levels we were previously at 6-7%, but we also have to take into account that's 6 or 7% over several years, and if it moderates to 5.5%, that's just another 5.5% year over year, in addition to the 2-3 years of inflation that we've already had. And so then if you take a look at this between the end of 2019 and the end of 2023, you take a look at total inflation during that period, and it's going to be sticker shock to a lot of people that prices rose that much. I think that's where I'm looking at this from the ground up.
Oh boy, listening to all this is definitely a doom and gloom outlook. Last year we had a doom and gloom outlook, and it pretty much came in. Let me give you one bright spot. Let's leave this little meeting here with a bright spot. There has to be some bit of good news, and I just mean good news. Something has to go up. That's how the markets work, and sometimes when markets crash, something else goes up. And so if we take a look at commodities had a pretty decent year this year. Nat gas was up big. Oil was up big at one point and then closed down. But I think this is actually the one spot on the market that I'm actually bullish. Now, let me be very clear here. I am not bullish oil because I think economic growth is going to remain constrained. And the thing I do love about capitalism is that capitalism, whenever there's a supply and demand imbalance, capitalism fixes it. And either fixes it by what's called demand destruction, where basically if there's not enough supply and everyone wants a product, what happens is people say, I don't want the supply anymore because prices went up so high. So we did get a little demand destruction up here, but what we also got was supply. There's been a lot of supply that's been coming on the market, even though what OPEC has been trying to clamp that down. The US producers and other producers are really driving it. And I think oil actually has a flat to down year. This is very different than what a lot of people are calling for. So I am not bullish in oil. However, I am actually really bullish for the first time in years on metals and chemicals. And we're already seeing, look at this performance. Look at the outperformance that this market is showing. We have gold breaking out to 6-month highs. We have copper breaking out. I actually really like the commodities market this year, and I think it's actually going to be a good year for commodities, except for oil and nat gas. Corey, what do you think about that?
Yeah, I agree with you on the metals, and I actually am a little more positive on energy just because now I don't know that they're going to skyrocket or anything, but I think some of that supply was actually the U.S. government, the SPR reserves, right? The strategic petroleum reserves they've been selling onto the market, and that's supply that has to be refilled. So it's temporary supply that's coming onto the market, driving oil down. And then as they fill up the SPR, it's temporary demand. And now they're kind of transitioning into that demand. So I think oil can maybe be a little bit better because of that. I also think that in terms of the consumer, we do have inflation recessionary risks, which could slow the consumer down. My thought is, and I could be wrong about this certainly, but my thought is that the consumer post 2020 COVID is just going to be a lot harder to get rid of in terms of travel, in terms of doing things. I think, sitting around for a lot of 2020 and not being able to do anything and so on, people want to get out and they want to travel and they want to, and that's a demand side for oil. So even though there might be recessions and things, I wonder if the consumer is going to be a little resilient in terms of wanting to basically travel, to drive, to do these sorts of things. Now, that's only one part of it. If the economy slows significantly, trucks slow down, there's other areas where energy consumption could fall. But I guess the only thing would be I'm a little bit more optimistic on energy, that it can be one of the bright spots. I would put it in that commodity trade, and I'm kind of optimistic on that side of things. But I would prefer gold and silver. Those charts look a lot better. No doubt about that.
Well, it sounds like you and I disagree on energy. I wanted to hear Darren's opinion on this.
Yeah, I want to ask a counterpoint question on the consumer. Okay. And I mean, this, energy is an input to everything that we do. All right. And you mentioned something, Corey, that I really twigged onto, is that the consumer wants. Okay. But how did the consumer spend in 2022? And I think it was largely with debt. But it's sneaky debt too. It's people looking at their credit card statements at the end of the month and going, I didn't buy anything big. I didn't do anything that I didn't do last year. Why is my bill so much higher this year? It's one of those things where they're going to be looking at where they would normally have tried to pay off their credit card balance at the end of the month. Maybe they can't. Okay, so I think we're running into, on the consumer side, we're running into, can they pay with actual cash versus do they have to go into debt? How long can they go into debt for before the debt service begins eating into what they would naturally buy, what they would naturally consume? And so while there's probably a societal want to go out and travel, to buy things, to do fun stuff, is there a societal ability to do that in the long term? And that, that's my question right there.
Yeah, and with rates rising and different pressures from the Fed, this kind of fits into how aggressive is the Fed? How much does the economy slow down? How bad is that for the consumer? And you kind of have to put those pieces together. My thought is that they're going to give up a lot of other things before they give up the energy consumption side of it. Before they give up travel, before they give up going out, they're going to cut back on other expenditures. They're not going to buy homes. They're not going to do other things. They're going to delay investment, whatever, not fund their IRAs, maybe try to cut other places, but still do that side of it. That would kind of be my thought, is that maybe it hangs in there even in a slowing economy, but it'll certainly be interesting to see. I am surprised also energy equities held up really, really well, even given the fact that oil kind of boomed and bust, right? Oil spiked up into the 100s and then came all the way back down to finish slightly negative, where energy equities held up. That little divergence is kind of interesting, because if you think energy stays down or even gets weaker, there's probably a downward trade for energy equities, which didn't trade particularly well today, by the way. But if energy can kind of rebound, those energy stocks are one of the areas of the market that can continue to have earnings growth and revenue growth and some of those things. So it'll be interesting to see how that plays out. The energy trade still has plenty of volatility to it based on how energy commodities trade this year.
Well, give us a tiebreaker, Rob. Give us a tiebreaker on energy and the consumer here. I want to hear your take.
I'll be very clear, very succinct, and very short. I think energy is down this year. I think energy ends up being the worst sector for 2023. That's my call right now. I think the consumer is flat. I don't think the consumer is a disaster. I don't think it's going to be great. I think consumer is flat. But I'm calling for energy to be the weakest sector this year.
All right, we've got a little bit of a side bet here. Now, I don't think energy goes back to back best performer, but I do think it holds in pretty well. I mean, my thought would be energy hangs in pretty well. So we'll see how the year ends up. Maybe we'll bet a little steak dinner or something.
All right. Sounds good to me. Right. Well, let's wrap up our predictions for 2023. So we are calling for another down year. And I really advise everyone, if you weren't trading or weren't watching the financial markets, go back to 2002. I think 2002 is a really good blueprint for what this year probably looks like. It was a year where everything was a little bit depressed, but look, the stock markets went down and were flat. The consumer held in. GDP was not negative. GDP was actually flat to positive. And good companies, and good in quotes, these stable companies that just plod along, they did just fine. All the speculative ones, they had a disaster of a year in 2002. The consumer hunkered down, but they were still doing a decent amount of spending. And so I don't think this is a great backdrop for a bull market. I actually think that the economy is going to do a little bit better than the market. I think the economy this year, and I can't remember what investment bank coined this, but I really like this. They said we're going to have a slow session. They said we're not going to have a recession. We're just going to have no growth for the whole year. That's what I think happens this year. I think the Fed keeps talking, and I think rates are going higher. I don't know about 6%, but I think they're going to get to 4.5%, 5%, no problem. I like the commodity sector. So my call is the commodity sector is going to be the best sector of the year. And I think the dollar goes lower. And again, those two are tied together. The US dollar and commodities have an inverse relationship. So if commodities go higher, the dollar is likely to go weaker. They just are linked together like that. Anything that Corey and Darren, you guys want to add before we wrap this up?
No, I mean, I think we've all worked on this. This is we've got some pretty good consensus, I think, where the difference is in magnitude of what we're going to get. I mean, I could see the first 6 months of the year being particularly ugly, but, and this is a homage to Mark Haynes, we need the Haynes bottom in this market. I mean, that got called in March of 2009. We just haven't seen it yet. I don't think anyone's been willing to make that call. Once we can get that, I'm thinking the May, June timeframe, then we can begin to claw our way back. I think that's the best case scenario where we can do. But what are we going to be doing this year? We're going to continue to add great traders. Again, I started this off. We're very happy with the performance our traders have done. You guys have all done great, finding the trend, being on the right side of the trend, managing your risk, allocating your capital correctly. Please keep doing it. We can't stress that enough. I mean, that our traders are what makes this firm as good as what it is. Now, I'm the inflation guy here, so we're not going to have a spring summit due to inflation. We took a look at what it was going to cost to get people in, and we were looking at flights, hotels, food, and everything like that. And it honestly has priced itself out this year. But we'll take a look at doing it again next year. But we're just going to have to continue on and keep doing what we're doing. We've added the psychology corner to the website. That is a great tool for a lot of videos and handouts to really assist our traders with that mental aspect. I started this out. That's one shift that we've made, and we're very happy that we've made it. And it's giving us dividends, giving our traders dividends. We're really happy with that. And as I said, we're going to continue to expand that multimedia and social media presence. We're going to look for that improvement of content delivery. How can we get timely, germane, important content out very quickly, where our traders don't have to sit down for 60 minutes and view an entire presentation that took, probably 25, 30 hours to make. We want to, how can we get that information out more quickly? So that's what we got going this year at Maverick. We appreciate everything you guys do. I mean, we know trading is simple. That's not to say it's easy. So we appreciate all your hard work. This is something you've got to be dedicated to do. And we know our traders are. So thank you very much. And we're really looking forward to a great 2023.
Yes, thanks to everyone at Maverick. We really love you guys, and you guys did awesome this year. So proud of you. Great job. Well, I think that wraps it up. Everyone have a great night. Goodbye.